Gold is now the largest reserve asset held by central banks. It just passed $1 this month. What is that telling you? It's that the world is looking for alternatives to the dollar. This country is not going to really face up to the reality until we bottom out. We're going to have a serious financial crisis in this country just to wake everybody up.
If you have any questions about how to navigate the current environment, Wealthion can help connect you with a vetted advisor to get a free portfolio review. Just click the link in the description below or head to wealthion.com/free. There's no obligation and it will just take a few minutes of your time. Again, that's wealthion.com/free. Hello and welcome to Wealthion. I'm Maggie Lake. Joining us to discuss the outlook for bonds, the Fed, and the deficit is Christopher Whalen, chairman of Whalen Global Advisors, editor of the Institutional Risk Analyst, and author of Inflated, Money, Debt, and the American Dream. Hey, Chris. So good to have you here.
Good morning, Maggie. Nice to be here.
So it's so interesting. You recently published a second edition of Inflated 15 years ago from the first, which tells me that a lot of these problems are still with us, very much with us. So talk to me a little bit about what prompted you to revisit the what's happening in the U.S. economy that prompted you to revisit this topic.
I think we put the first edition out too early because people really weren't thinking about inflation. They were still convinced that everything was fine and we didn't have to make any changes. I really wanted to edit the book because when I wrote it in 2010, things were a little confused. Everybody I knew on Wall Street was broke. The guys at Wiley were kind of running around. So this time, it's a much better product. I took about 20,000 words out of the front. I took the Henry Ford stuff out because I published that in my Ford book. And then I put a new chapter in the back that tries to make sense of where we're going. Because the whole point of the book is to tell Americans how we got here. How did we end up as the world's money?
Yeah.
You know, how did all of this stuff happen? And to prepare them, I think, for what's next, which is the decline of the dollar as the de facto world currency, the resurgence of gold. Gold prices are up dramatically this week. And I think that, you know, for better or for worse, we've got to learn to be just another country in the world. The American exceptionalism of the last 100 years or so, particularly after the world wars, was never meant to last forever. The role of the dollar as the default global currency was an anomaly. And it's hard for Americans to think about this because they're entitled. They believe that we should just be, continue to behave the way we have been. But I don't think that's the case.
Yeah, I wanted to ask you that and just set this conversation up with that because there's some really big themes there. And I feel like you're right in this environment we're in now, in really the last year or so, some of these big topics that folks like you have been thinking about are starting to hit us in the face hard. We're starting to actually see it show up in the market, see that sort of intersection of these big macro themes start to filter into the everyday, which is, a lot of people listening to this are going to open their 401s and they're trying to figure out, what does this look like? What should my portfolio look like? And I feel like it's sort of like the rubber's hitting the road here. So super appreciate that you went back and did that. And so, when you say Americans, it's really hard for people to digest that with good reason, right? We're looking at stock markets that are not that far off their high, and you're getting another message from that side of the market that's sort of, telling you that this is where exceptionalism is. And, we're in this bull rally and there's no other alternative. People who sold the dip and got out in April, if you went back in, you were rewarded, especially those retail investors.
Oh, yeah.
So
I went back in.
Yeah. Yeah. Well, and we'll talk about maybe separating.
Banks. So I went and bought American Express on a 5 handle in terms of book value. It went back up to a 7. So in 3 months, I made almost 30%.
Yeah.
Just because that was one of the leaders in my group. I thought, okay, this is cheap. Same thing with Fannie Mae. I made almost 25% in 3 weeks on Fannie Mae. That's a very strange trade, though. That's a Washington trade.
Yeah.
But the point of the markets, you raise a very important question is why are they up so much? Because of inflation. Americans think that what they see in stock prices is a reflection of value. No, it's a reflection of inflation. And also, I think the fact that the U.S. market is still one of the few markets in the world that is functional. You just don't see markets like this in Asia or even Europe. So that's why we attract all this capital. You have people who probably sold in April, like you said, but the smart ones went in and bought. And in fact, I was telling my readers, I said, this is a distraction. Don't pay attention to tariffs. And it turned out to be right.
So explain to me why this is not about value, it's about inflation. Explain that a little bit.
The Fed has been an engine of inflation in the United States really since inception. It's there to provide liquidity. That's why we call it a central bank. There's nothing free market. There's nothing conservative about central banks. They are socialist institutions that provide liquidity on an aggregate basis. And essentially, they're trying to prevent the losers from losing big because that results in deflation. That's what we had in the 1930s. You had a lot of people lose at the same time. The entire U.S. economy liquidated down. All of the private debt in the U.S. was liquidated in the 1930s, if you can imagine that. So today, we have a society that has been rewarded by issuing lots of paper, lots of debt. And people around the world love it because they can use dollars to finance their own economies. They don't finance in their local currencies. They borrow in dollars and then swap it into something else. China is a great example of this. So we've created this market, but unfortunately, we don't have the discipline to live within our means. We also are kind of forced to run a big currency because that's really part of what the whole reserve status of the dollar is about. There's lots of it out there. You have lots of collateral you can use for financing. Treasury debt is not just about interest rates, it's about collateral. So I think, unfortunately, because we haven't had the discipline to keep our budget deficits under control, you see more and more volatility in the stock market that ultimately comes from inflation. It has nothing to do with the U.S. economy. And I think that's how I look at it. I look for the big ebb and flow as a buying opportunity. When I see it's going to sell off, I go put on the negative S&Ps. And when it bottoms the way it did in April, you go the other way, you go long.
If you're looking for a simple, secure way to invest in physical gold and silver, check out Hard Assets Alliance at hardassetsalliance.com. Speaking of silver, Wealthion will be on the ground at the SCP Resource Finance Global Silver Conference this October in Toronto, where Eric Sprott will deliver the keynote address. It's going to be a major event for silver investors, so stay tuned for more details in the weeks ahead. So the idea that we are sort of reached the end of this American exceptionalism and are ultimately going to move away from the U.S. as a dollar, that sounds on the surface of it as super negative for equities, but it sounds like you're saying it's just going to introduce a lot of volatility as we make that change. So not an absolute, sell America trade.
No, not at all. I think you have to remember, and this goes back to the early part of the book when I talked about Jim Fisk and Jay Gould. They were one of the first speculators in America to perceive an arbitrage between real value, which was gold, and paper. And they thought, oh, well, we can play this game, right? So they were really adept at playing the ups and downs of paper versus gold, securities versus gold, that sort of thing. They tried to corner the gold market during the Grant administration, of course. Nothing's changed, really. Today, you have the same sort of stuff going on. We have one hype after another. AI, for example, which I love. What is AI? AI is an electronic parrot. And Americans are delighted to sit in their homes and talk to their computers for hours at a time, thinking that they're talking to a person. Well, we've managed to take this functionality and turn it into a whole market. It's called NVIDIA. I've been in and out of NVIDIA 3 times. And each time I've made, double, triple digits on that stock. So hat tip to Jim Cramer, by the way. And I think they are the poster child for this age. When you see the fact that half a dozen stocks are responsible for most of the moves in the major indices, that kind of tells you something. Although it's interesting, we just published our bank quarterly for the third quarter. You'd be surprised. The only large cap bank in my top 10 right now is Citi, the most improved student in the class. They're still trading below book value, by the way, but they've almost doubled over the past 18 months. So we have ebb and flows here. It's not like the population is static at all.
Yeah, I think that's so important because when people talk about this and a variation of it's the end of the dollar and it's the time for the rest of the world, and obviously gold, it has been a big topic. It seems like everyone thinks this is imminent and going to happen and definitive for all other assets. And you lay out a much different situation here where yes, things are shifting. It sounds like it's moving the Titanic and it's going to result in change. But in that sort of volatility, there's also opportunity.
Oh, very definitely. See, think of it this way. Where else can we go out of dollars? Imagine the Chinese sold all their treasury bonds tomorrow. Where would they go?
Mm.
There aren't enough markets out there that are big enough to accommodate even a modest migration out of dollars. We saw this back in April. You had a lot of people talking to the media saying, oh, we're getting out of dollars. We're going to go invest in the UK, for example. No, that market is tiny and it is not growing. Same thing with Europe. Same thing with Japan. So once we get past the euro and Japan, which are the next largest currencies, where do you go? The answer is gold. Gold is now the largest reserve asset held by central banks. It just passed the dollar this month. What is that telling you? It's that the world is looking for alternatives to the dollar, but it's not really in the playbook of the Chinese or the Europeans to expand their currencies and to grow inflation, okay, which is what we're talking about here, to accommodate inflows from other countries. They don't want to do that. The classic example of this is Switzerland. You've always had people come to the Swiss and say, hey, we want to put more assets in your country. You know what the Swiss say? No. They say, go away.
Because there's a lot of pressure and responsibility that comes with.
Well, they don't want the inflation. See, the U.S. has had to tolerate a very large degree of inflation, which is why we're talking about this now. COVID brought it to the forefront, even though it was always there, right? But it went from single digits every year to double digits in a year. And that really focused Americans on this issue of inflation, which has historically been a big issue. If you were back 100 years ago in the 1920s, after World War I, inflation in the cities, food prices, housing prices were one of the biggest issues. So in a sense, it's come back. But I think what Americans have to understand is we do have to live within our means. And we are eventually going to have to forget about the baby boom, forget about the party after World War II, which is what we've been doing, thinking that we could just borrow money forever, which is hubris, obviously. And now we have to try and be one country, a very large, important country among others. And we're going to go back to a multilateral currency environment where, yes, the dollar is going to compete with other currencies. It's like we wound the clock back 50 years to the 1970s when Nixon closed the gold window and John Connally, who was Treasury Secretary at the time, said the dollar's our currency and your problem. Well, not so much anymore, right?
Yeah.
Things have changed a bit.
Yeah, and you're talking about like just massive cultural shift. Can you said this is sort of gold's time? Can gold, or are you suggesting that gold replaces the dollar? Can a hard asset actually play that role given the financialization of the world economy that we've seen?
Yes, but again, it raises the issue. If I'm building the largest market in the world on top of a fiat currency, which is the dollar, and I'm also adding more debt. In other words, the fiat dollar and debt are one and the same. They both promise you nothing, right? I'll give you more fiat currency. But when you have a hard asset like gold competing with the dollar again, after a long period of time when the U.S., other nations tried to push gold into the corner and say, oh, no, we're not going to talk about gold anymore. Well, guess what? The rest of the world has decided otherwise. The Chinese have led this discussion since the opening of the Shanghai gold market in 2002. And you can see the other central banks now migrating away from dollars. They're not buying based on price, Maggie. They're buying based on volume. And there is a limited amount of deliverable physical gold out there. So, I tell my readers, I want to see them with at least 10% gold in their portfolio, futures, physical, whatever they want, because I think that price has got to go up. There's just not enough physical out there to even begin to meet the demand. And remember, in the U.S., what's gold in most investment portfolios? 1%? Maybe? Not even. So when you start to see that number go up, guess what? Gold prices are going to rise.
And you just brought up a really good point in how you express that, because for a lot of people, this is an area that is tricky, is something they haven't sort of looked at, haven't had to answer questions about it. You're okay with futures, gold futures too, as long as you're exposed. That's
Yes.
okay.
Well, I like my clients to buy puts and calls. I don't want to see them going short.
Mhm.
I think you have to define your strategy and you want to quantify your risk going in. That's the best way to do it. You know, I've been a trader for many years. I'm an investment banker, and I always put limits on my own activities because I just don't have time to stare at a screen all day. So if I want to go short, I'll buy puts. You know, occasionally I'll put a short position on some of my stocks. But the other thing I'm very big on is, like, I'll give you a great example, NVIDIA. Every time that stock goes up, I have to go and readjust my sell orders because I protect that position. I've got about a 60% gain in NVIDIA right now, and I want to keep it. So if it trades through my sell, then that's fine. I'll just watch it for a little while, and then maybe I'll get back in.
Yeah. So important to have an active view. And I know some of you listening to this are thinking about, if this sounds like it's out of your range of skill, we're going to drop a link of where you can talk to an advisor or get a free review of your portfolio, because I think we all need to
Exactly.
get more hands-on. Chris, every time I hear you
Look,
say
even
this,
Chris the banker needs help.
yes, that's right. We all do. I mean, this is a different time. So talk to me a little bit about the tariff situation that we're dealing with now. This is something newer. We just had a court ruling as we are speaking right now. Of course, these
Right.
situations change moment to moment, but it's affecting the bond market. How are you thinking about this topic that seems so uncertain and has so many twists and turns now? Do we know the impact? Are we going to have to pay back the money? Does something that you think is going to cause issues for the bond market? Are you paying attention? How are you thinking about that?
I think the media likes to talk about tariffs. Economists like to talk about tariffs because they can. I don't think tariffs at the end of the day are really going to make much of a difference to stock prices. If the kerfluffle in the media gets active enough and loud enough, then stocks may trade off. I see that as a buying opportunity. I really think that the whole tariff discussion this year has been an enormous distraction and an enormous opportunity. I wish they would make my banks trade off again. Please go right ahead. So I don't think we can know the answer to the question you just asked, Maggie. And the fact that economists will sit here and waste our time trying to guess what the impact of tariffs is absurd. Every single exporter who sells goods in the United States has to make a decision. Do they internalize the cost of the tariff and not change their price in the US? For a lot of Chinese companies, that's exactly what they're going to do. So what's the net impact of that on American consumers? It's reducing the profitability of a Chinese exporter, right? And yet the media in this country, because they like to generalize about such things, even though it's entirely speculative to do so, right? They come out with these, headlines in 50-point capital letters saying, oh my God, tariffs, inflation. And the Fed has been doing this too. The fact that the Federal Reserve Board will sit there and ponder what's going on with tariffs when they have much better things to do, by the way, I find extraordinary. I hope that President Trump does get control of the Fed sooner rather than later, because we need to refocus them on what their job is in the law and get them out of playing this economic planning agency out of the old Soviet Union. I always say that the Fed is Gosplan. You remember what that was?
No.
That was the state planning agency in Soviet
the
Russia.
5-year plan they put out and changed everything.
Right. The Fed is a progressive institution that was largely changed during the administration of Franklin Delano Roosevelt. We don't need that kind of agency in Washington. We need to get them focused on their job and get them away from sitting here. I'll give you an example. They use a model of GDP to estimate, they think, how much liquidity we need in the money markets. When we get up to September 15th, which is a big tax day, there's a lot of money moving around Wall Street that day, we could have a financial crisis in this country again because Chair Powell is more concerned about tariffs than he is about their real job, which is the money markets.
I just going to ask you, what is their real job? Explain it for some lay people who may not be, as sort of knowledgeable about the inner workings of the Fed. If they shouldn't be forecasting and worrying about tariffs, what should they be doing?
They should be worried about what's actually happening, what's happening with employment now, what's happening with interest rates now. But when they get into this speculative planning mode where they, try and figure out what the neutral rate of interest is, R star, which is something they can't even observe or quantify, but we're going to use that for public policy, I think that's irresponsible. When they sit here and speculate about the impact of tariffs today or next week or next year, again, they don't know. And I would really challenge them to say, what are you doing? This is not your job.
Mm.
You're not here to speculate. You're here to manage the U.S. economy in a very short-term sense, which is employment and price stability. That's what the law says. And I hope we can get them back to that.
Do you worry that reform, the sort of effort to push for reform, even if it's needed, just ends up having them at the will of one of the branches of government, to do their bidding, and sort of takes away any independence? And I know we can argue to what extent they are political or non-political, but do you worry reform can end badly and not in the way that you're talking about?
Fed independence is an illusion that we had after the war. In 1951, the Fed won their independence back from Treasury after keeping interest rates stable during World War II, when they financed most of the government's needs. When you have as much debt and the large deficits that we have today, the whole notion of Fed independence is absurd. The Fed is an appendage of the Treasury. They are, in fact, the opposite of the Treasury. Why? Because the liability at the Treasury, their debt, is considered an asset at the Fed. Isn't that neat? It's one of the little layers of leverage that we created in this country, which drove a lot of growth. Let's be very plain here, right? This has been a good thing. But when the Treasury has as much debt as they have today, they are the only thing that matters.
Mm.
When we're funding a large chunk of federal expenditures every year with debt, guess what? The changes in the Treasury General Account, which is at the Fed, that's where the Treasury keeps their cash, that movement on a weekly or even daily basis is much more important than anything that the folks at the Fed have to say at that big table. The Treasury is the dog. The Fed is the tail. That's it. And until we get the fiscal situation in this country under control, the Fed is almost irrelevant. People talk about fiscal dominance, for example. Yes, because the Treasury is going to go out and issue $2 trillion worth of debt between now and the end of the year. That's all that matters.
I've had folks say that given the situation, given the deficit and the situation in the U.S., that U.S. Treasuries are uninvestable.
No, I disagree. They are a place for keeping cash. They're not a place to do long-term investing. I own mostly T-bills. Your clients or your viewers may find this interesting. I own a lot of bank preferreds. I own Annaly, the big mortgage-backed securities REIT, because I understand them. They throw off, mid to high double-digit returns on government securities, right? So you want to think of treasuries, you want to think of the dollar even as a place for short-term money. But you got to think very hard about where you put your long-term money. I would say gold, very well chosen real estate, and even some foreign currency assets are what you should be thinking of, because a dollar over time, I believe, is going to lose a lot of value.
Yeah. Do you see that decline as, and does it matter, as orderly, as a sort of, again, long-term trend, or are we likely to see more volatility and bigger pockets, fast pockets of weakness? I mean, currency crises or currencies are notorious for sometimes being the spark of a crisis. Certainly was in Asia, back in the day. So what are you keeping an eye on in terms of currency? What should we all be aware of?
Well, the dollar is kind of at the low point again. We're down below the levels where we were during Trump 1. And I think volatility is going to be really what you have to be concerned about, up and down. You're going to have both. Again, where do we run if we want to run out of dollars? There isn't an easy answer for that. If you're the Bank of China, imagine we sell all of your treasuries tomorrow. We're in dollar cash. What do? Do we go out and buy Indian rupees? Japanese yen? There really aren't a lot of alternatives. So you're going to see people looking for alternatives. You're going to see countries maybe starting to create a pool of assets that could be an alternative. But give you an example. Look at all of the financing that's been done in Hong Kong this year. The number is still tiny. if you compare that to what's going on in the US. But again, inflation is what's driving the US market. We're doing fewer, bigger deals. You see this in the mortgage market too, by the way. You can see more larger loans, but we're doing fewer loans in total. In fact, we're doing half the number of mortgage loans that we did a decade ago in this country. But the price inflation of homes, 40% since COVID, is actually making the market look like it's growing, even though it's not.
That's a fantastic point. I think anecdotally, we probably all feel that. For anybody who's been in the market, you see what's happening, and the volume is down, but then you do see those few transactions that are really, really
And
high.
we're heading for a correction in housing. I wrote a biography of Stan Middleman, the founder of Freedom Mortgage, and it came out in 2024. And Stan predicts, he's very good at this. He said, misery on the eights. We're going to have a major home price reset. After the Fed drops rates, we're going to see a little surge in volumes in real estate lending. But there's already so much accumulated inventory out there that can't find a buyer. A lot of new construction in Texas and Florida and the Carolinas. That eventually is going to correct downward, I think. We could go back down to 2020 price levels.
Wow.
Think about that.
Yeah. So I want to ask you, you're talking about alternatives while we're on this topic, and then I want to circle back to debt. Alternatives, where do we go? What do you make of the idea that it's going to be some sort of digital innovation, a stable coin, some kind of cryptocurrency, something like in that area, that there are people working on building ecosystems that are looking to replace fiat currencies? Do you think that the answer lies there somewhere?
No, fiat currencies are a function of government. The legal tender laws in this country settled that a long time ago. And I would point out the fact that there's more than a dozen states now that have passed laws that allow people to specify gold in contracts as a form of payment. So I tie crypto and all the rest of it to the dollar. If the dollar continues to be liquid and used, and you're going to see people trading cryptocurrencies, especially in the US. But when you go to Asia, people play with coins, but they invest their real money in gold. Okay, they're very clear about how they differentiate between the two activities. And I think most of the rest of the world is migrating back to gold. It's kind of the alternative to the dollar. I think the whole crypto phenomenon is just a speculative bubble. And I'm very concerned about it because what do we see now? We see people raising money in the equity markets to invest in crypto, which is a dead asset. It has no carry. And they're using what we call perpetual futures, perps, to make this market look bigger than it really is. These futures never really settle, so they just go round and round and round. Well, what is that? That's a Ponzi scheme. So I am very much a seller of crypto and a buyer of gold.
Very interesting. I know we're going to have some strong response to that, but you said something really important there, which is I think the worry has always been, will governments be okay sort of allowing this alternative ecosystem? It's the reason it was created, but will they be okay with it? You kind of put that in a different way, saying that ultimately this is about government funding, government controls fiat. So if you don't have anything like that behind it, then kind of, what's the point? What's the anchor? What role is it playing? That's a very interesting way to think about it.
Look, crypto competes with the dollar if we let it. But I think ultimately the U.S. is going to have to ban cryptocurrencies to defend the dollar. If you saw a major sell-off in the dollar and a migration of even a modestly small percentage of the population in the cryptocurrencies, the U.S. would be forced to respond. There's no question about it. I mean, look at China. First thing that China did when they saw crypto was they banned it. And then they encourage their citizens to buy physical gold. You can open a bank account in China to buy as little as a gram of physical gold. And why do they have 1 kilo bars in Asia? Because they're easy to transport. They're not using the big old-fashioned gold bars for good delivery. They are going to much smaller units of gold because they want it to proliferate. They want to have an alternative. So I think, look, I have no problem with people making money on Bitcoin and speculating on crypto, but just realize it's a zero-sum game. When you saw that big whale get out a few weeks ago, that was someone who had a huge paper gain in their crypto. And so, time to go. And so they're going into other assets. They go into real estate. They go into dollars. They go into foreign currencies, whatever it is. But again, remember Fisk and Gould. It's about arbitrage between real value and perceived value. That's all that matters. And nothing has changed. I wish they were around here today so they could tell us how they view crypto. That would be interesting.
That would be interesting.
Imagine
Maybe
Jay
you should
Gould
have
on
a
crypto.
fictional conversation with them. Have a stand-in, someone to
That's right.
represent. I mean, this is why it's important that folks like you sort of remind us of the history, though, Chris. I'll just say because it's easy to forget
The
that.
dollar was the first cryptocurrency. That's all you have to remember. When it was first introduced, it bore interest. It was considered debt. And they didn't even, you had to write a date on it when it first came out because they used it to pay for the Civil War. That's what it was for. When FDR seized gold, he was trying to do a little social engineering in the 1930s, trying to convince people that, gold was a bad thing. It was a political move more than anything else. Because what's interesting? The Fed, from its creation in 1913 all the way through to World War II, was never constrained by the link to gold. They could have expanded liquidity if they wanted to, but they didn't know what to do. They didn't have the information that they needed, and they made bad decisions, which is something that central banks do all the time. But I think it's fascinating that there was never actually a constraint on the Fed's balance sheet when it came to the link with gold.
Mm. So do you think, facing the deficit now, do you think there is a credible plan or maybe desire on the part of the Trump administration to try to get the deficit under control? Surely Scott Bessent understands the dynamics that you describe.
We hope so. The president shows no inclination to worry about the deficit. He's a real estate developer. They hate that. And I think, to me, would he like to solve the problem of the deficit? Yes. But this country is not going to really face up to the reality until we bottom out. We're going to have a serious financial crisis in this country just to wake everybody up. Because go back to 1933 when we had the New Deal. They basically just walked out on the floor of the Congress and said, here you go, vote for this. And the whole democratic process broke down. We had a dictator named Franklin Roosevelt. So I think much the same way, when you leave politics intact, and when you ask people, to compromise and do everything else that we see in our political system, that's not going to get you to a sound currency. It's almost impossible to have a sound currency in a democracy. Because once we tell everybody that they should have the same outcome as everybody else, how do you limit spending? That's the great progressive promise. But I'll tell you this, the change in the dollar and the rise of gold, it means the end of the progressive experiment in the United States. Because what do we do if we can't just endlessly spend money? What do we do if we actually have to be aware of things like interest rates and the value of the dollar? That's going to be a big change for Americans. I'm not sure they're ready for it.
What does that, well, we are as a country clearly not ready for it, but what does that, I think we can all agree on that. What does that, a lot of us are going to worry when we hear that we have to have a major bottoming out, a major crisis in order to usher in change, a cultural change. What does that look like? Where are you looking for those cracks to start showing?
Well, the cracks will show up in long-term interest rates. If we start to see the 10-year Treasury heading towards 5% or higher, that's when the machinery is going to really come under great pressure, because that's going to tell people that they can't finance new companies, new industries, new projects, because long-term rates are too high. Everybody has grown very used to the fact that the Fed can change this target for Fed funds, and they nationalized the Fed funds market 30 years ago as part of policy. And they thought, well, we could just adjust the short-term interest rate and get the economic outcomes that we want. Well, what happens if the Fed now drops interest rates, but the 10-year Treasury goes higher in yield? The yield curve gets steeper. That tells you that there's more risk in the system. It tells you the housing is going to slow down. Home prices are going to fall. You're going to have a lot of problems in the multifamily market, which is the new subprime, by the way. Urban apartment buildings are the new subprime asset in the United States. Why is that? Because of inflation. The fact that we have a mayoral candidate in New York who wants to freeze rent on rent-stabilized apartments. What does he think is going to happen to those buildings if the landlords can't take care of them? So this is all about inflation. It comes from debt. If you don't want high inflation, you got to stop spending money you don't have. That's the conversation we have to have in this country. Imagine if the U.S. only did things that were covered by tax revenues this year. Think about it, Maggie. Almost about 40% of spending this year is going to be funded with debt. Imagine if we didn't spend that money. What do you think the U.S. economy would look like? Medicare, Medicaid, military spending. See, that's really the rub here. If we had to raise taxes enough to cover all of this stuff, we'd have higher tax rates in Europe.
Do we, and it sounds like we are going that direction, whether we like it or
Yes.
not, because it's going to be, if you're correct, it's going to be forced by some kind of financial crisis. Does it happen without social unrest?
No. I remember when I was a kid, we had the riots in 1968. We had the 82nd Airborne Division camped across the street from my house in Cleveland Park. We could go back there very quickly. As my dad told me, he grew up in the 1930s. He passed away a few years ago. He said, Chris, the New Deal was about keeping people out of the streets. And Americans forget that. Americans forget how radical this country was 100 years ago. Socialism is not a new thing in America. We had very interesting socialists 100 years ago in this country. My ancestors were all in Tammany Hall here in New York. So I think that we're just going to see a return to many of those social patterns that we've already seen. And it's going to force us to turn inward. It's going to force the U.S. to be less engaged with the rest of the world. Those are big changes.
They're very big changes. And it sounds like an era where people have to be very defensive. It sounds like an era that's about capital preservation. But
Yes.
I guess we have to look for opportunity too. And does it worry you that so many people are very passive about their investments? We've talked about this a lot, kind of rolls in, and a lot of us are not used to having to sort of get in the minutia of how we should be trying to think about this. Does that worry you? Are we kind of sleepwalking into this?
Well, when you have a market that has more ETFs than stocks, yes. Look at the stocks that have been added to the major indices over the past year. Are these really high quality stocks, or are they, the byproduct of financialization, which is, we've turned our markets into a big game. It's funny when you see younger people trading cryptocurrencies. I have a number of friends who are involved in that market, and it's basically just a big game for them. It's like they're playing with a computer game. So
Yeah.
I think that is an interesting trend, because eventually we may have to be more concerned about substance as opposed to appearances. And that's a big change for Wall Street.
Yeah. For me, I think it looks so much like every other sort of handheld gambling, right? It's like fantasy football. It's the betting
Sure.
markets. It's like all looks a little bit similar, which worries
Well, in
me.
FINRA world, I served on a FINRA committee for 15 years. We call it gamification.
Mm-hmm.
To what degree are you encouraging people to get involved in a speculative investing activity by making it look like a game? And I think people are very vulnerable to this because humans are hardwired to chase the shiny object. They can't help themselves. It's part of the instinct that makes you want to eat. Okay, eating is about survival. So when you show people a way to apparently make a lot of money in a short period of time, they're going to chase that shiny object. That's what cryptocurrencies are about. You can't convince them that they're wrong. You can't convince them that they're playing a zero-sum game. And that's why the smart ones get out early. You're taking somebody else's money off the table, and then off you go.
That's always the worry. I've had a lot of conversations about the house always wins with my son.
The house always wins. That's right.
Yeah. I just want to finish with this last. I like to anticipate the sort of people thinking like, hang on a second, but what about this? Let's just end on AI. So it sounds like you think it's a bubble, an electronic parrot, but do you not see this as just a sort of increase of technology kind of taking over the world and unleashing productivity? Is there any real in the AI to you? Are you differentiating the technology versus some of the investing around it? Or do you just think the whole thing seems like a bubble?
Computers really do two things. They add and subtract, and they sort. When you throw a lot of horsepower behind that, you can start to suck up all of the existing language, all of the existing content, and then the computer is going to pretend that it understands the words. So you say to it, go find such and such. I used a Google search, for example. And it is interesting and it is useful if I know what I'm looking for. But if you just ask it a question, these large language models have a very strange tendency to give you back answers that don't make any sense at all. My favorite that I saw the other day was a restaurant. People were asking about the specials at a restaurant, and the AI bot was coming up with specials that didn't exist, that they didn't actually have at the restaurant. So you got to realize that these are still just computers. They don't understand anything. They don't think. They are not intelligent, but they do give you a response. And that's why people will talk to these things for hours. But it is ultimately a parrot. That's really what it is. So as long as you understand that you're talking to a parrot, it's okay. Look, and I've made a lot of money on NVIDIA. I don't want people to think that a company like NVIDIA has no value. The technology that they have created is extraordinary. But the point is, what are we doing with it other than wasting a lot of money on electricity? That to me is the real question with AI. What is it really going to give us in terms of productivity, accuracy, dependability? These are all issues. Remember the self-driving car that Tesla and GM has been working on? Why hasn't it rolled out yet? Well, number one is dependability. They still can't get it to the point where it's not going to throw off errors and periodically kill people. And then, of course, we got to find an insurance company that wants to cover that risk before you can proliferate these things. So all of these new technologies are neat, but we got to remember that computers don't really think. It's simulated cognition. And that was Ray Kurzweil, by the way, before they drafted him into the AI camp. His initial take on all of this was that it was just simulated cognition.
Amazing stuff. Well, super happy that we're not talking to a parrot today, Chris, because it's always wonderful. Thank you so much for your insight and sort of sharing all your years of expertise and for going back at it and put that second edition out so we can all sort of remind ourselves of where we're headed. So
My pleasure. And the audio book is out now in case you don't want to read.
Awesome. Put it on when you take your walk, like a podcast. We'll all do that. Thank you so much. And given all of the great comments and thought-provoking things Chris just said, if you'd like to take a fresh look at your portfolio, your allocations, your holdings of gold, just a reminder, you can get that free review with an advisor in the Wealthion network. Just head over to wealthion.com/free. Thanks so much, everybody, for watching. We'll see you next time.